Okay, students. So in this chapter, we are going to discuss some questions on the working capital management. Question number one is Westerly Industry has the following financial information. What is its cash conversion cycle? Cash conversion cycle is a cycle. Actually, it's a time period where we time to collect actually the cash. How fast, how quickly you get back your cash. So this is cash conversion cycle. So this information is given. Some part of the information is coming from the income statement and some part of the information is coming from balance sheet. Okay. So we will need two statements if we are asked to calculate cash conversion cycle. So what is the formula? Please remember in the exam, these formulas will be given to you. Okay. So calculate the components, inventory. We need to see inventory, we need to see receivable, and we need to see payables. So first of all, this is the formula that you need to remember. Inventory days plus receivable days minus payable days. Okay. So first of all, what is the formula for the inventory days? Inventory days mean how quickly you convert your inventory into uh, into into final product. Okay, how quickly you convert your inventory into cost of goods sold or final product. Account receivable mean how quickly you get back your cash receivable or credit sale, and payable mean how much time do you take to pay back your payables. So this is all we need to do. So inventory balance in the balance sheet divided by CGS coming from the income statement divided by 365, because we are converting it into days. So we have to convert the annual cost of goods sold by 365 to get it a yearly information. Okay. So inventory is how much? This is 15,000. Okay. CGS is 80,000, and you get this information 68,000, 68.44 days. Okay. Then receivable days, receivables are also given. So they are 32,000. In fact, they are not 30. Sorry, I actually overlooked it. This is 32,000 divided by sale. Sale is 100,000. Yeah, this is please correct this information. This is 30. This is 32,000. So we should write 32,000 divided by sales out of 365, and we will get 109.5. Okay, so if I calculate this, 32,000 100,000 divided by 365 73. Yeah, it will be 116.7. Okay, if we use 32,000. Then we have payable. Account payable, they are 40,000. Okay, 40,000 divided by 80,000 and 365, and we will get 182. I don't know why haven't I. Normally I do check the information. It's my bad. 219. Yeah, this is 182. Okay. So this is 40,000, but the answer is correct. So we just need to use this information. 68 is correct. Then 116.7 minus 182, and whatever is the day for the cash conversion cycle. Okay, so please correct this information. Next. Uh, okay, so Aberdeen Outboard Motor is contemplating building a new plant. The company anticipates that the plant will require an initial investment of $2.11 million in net working capital today. So this is like this. So they will require more working capital. So more working capital means increase in working capital. So it means $2.11 million is an outflow. Okay, million. The plant will last 11 years, at which point the full investment in the net working capital will be recovered. So it means after 11 years, we will be using the working capital. It will remain constant, but at the end of the 11th year, so this will be recovered, mean we will not need this 2.11 million working capital. So it will be an inflow. Okay, so it will be plus 2.11 million after 11 years. Same working capital. Given the annual discount rate is 6.4%, what is the present value, net present value of this working capital investment? So if the rate is 6.4%, what is the present value? So we are not given any other information like sales or anything else. So we just need to find the NPV of working capital. So it's a very simple case. This is future value. Okay, so this is initial cash outflow. So simple, we need to do the NPV formula. So it is initial cash outflow plus present value of cash inflow. So same thing, initial cash outflow is this one. Okay, and the same information will be recovered after 11th year, and 1.064 power 11, and this will be our answer, NPV. Okay, it is negative. Of course, because the same amount is being discounted, but the other amount is a negative, it is not being discounted. So the negative answer will be higher. Okay, any questions so far, students? Okay, you can stop me if you have any issues. Okay, the Greek connection had sale of 32 in 2015. In 2015, they had sales and cost of goods sold of 12.8 million. So this is CGS. A simplified balance sheet for the firm appears below. Okay, so it means that they have not given you the income statement. Questions may also give you the information of income statement, but they, from the income statement, they have given you the information of sale, and from the income statement they have given you the information of CGS. So this is all what we need from the income statement. But from the balance sheet, of course, we need more inputs. Okay, so from the following balance sheet, we need to calculate the Greek's net working capital in 2015, cash conversion cycle, and then the question is saying that if the industry average account receivable days is 30 days, what would have been the cash conversion cycle for the Greek connection in 2015 had it matched the industry average for the account receivable? So it means if the account receivable days of this company are similar to the industry, what would be its cash conversion cycle? We need to calculate that. Okay. So similar to our first question, we need to calculate cash conversion. First of all, net working capital. Okay. So net working capital is current assets minus current liabilities. Current assets minus current liabilities 7782 minus sorry, current assets minus current liabilities. Okay. So current assets are how many? So if you see, these are the current assets that you will be taking, and current liabilities are these one. Okay. So if you subtract that, then you will get the answer. So this is net working capital. Okay. But then some people, they also uh, use another formula. So they calculate net operating working capital. Okay. So they also calculate net operating working capital. So in the net working operating capital, they exclude those payables where there is interest payment. So like on account payable, we don't need to pay any interest payment. Notes payable are basically short-term loans. On these loans, we pay some interest, and accruals are also part of that. Okay, so normally they exclude these two components when they calculate net operating working capital. So what do we need to do then? So if you see, net working um, net operating working capital is equal to current assets minus uh, notes payable plus accruals. Okay. Uh, then yeah. So you see that this is total assets 7782. Then notes payable are how many? 1000 and 1220. Okay. So 1300 plus 1220. So this is yeah. Sorry. This notes payable is only in the interest bearing. So this will not be included. Only these will be included, accruals and payables, because the only interest rate that we pay, like a bank draft and some other short-term interest payments that the company borrows, so these are not payable, so they do not include this one, but rest they will include account payable and accruals. Okay, so what total current assets will remain the same, but we will exclude notes payable. Why? Because they are interest bearing liabilities. Okay, so 1300 plus 1220, so this will be our answer. Now the cash conversion cycle we need to calculate. Cash conversion cycle is equal to inventory, then account receivable, and then account payable. Okay, so inventory is how much? So we need to simply take inventory, that is 1.414. Okay, divided by CGS is how much? CGS was given, so that is 12.8. Okay, divided by 365, we will get it. Okay, so it will give us inventory turnover. Account receivable are also given, so account receivable are there, 444 so uh, this is the account receivable divided by sale divided by 365, and similarly account payable is 1.3, mean they have rounded it, 1.3 divided by 12.8, the answer is 37.07. So if you add them all and subtract payable, you will get this answer. Okay, So this is the cash conversion cycle. So the question is saying that if the payable day is 30-day industry day, so what will be our answer? So it means the company's payable receivable days are 50.35 days. So it takes 50 days for the company to convert their credit sale into cash. So but in industry it is 30 days. So if it means the company is taking more time to collect its receivable, convert its receivable into cash. So we need to convert it. So if we but in the industry it is 30, so it means company is not performing well. So if we use 30, so this will be our cash conversion cycle. Okay, so it means the cash conversion cycle of the company is higher than the, if we had used the industry receivable cycle. So company should reduce this cycle, the receivable cycle. Okay, now let's take our question about the credit sale. Simple Simpson Bakery purchases supplies on terms of 1.710 net 25. So it means that total credit days are 25, 0, and if the company pays back in 10 days, the company will get a discount of 1.7%. Okay, it will pay back 1.7%. If Simons chooses to take the discount offer, it must obtain a bank loan to meet its short-term financing needs. A local bank has quoted Simon's honor an interest rate of 10.8% on borrowed funds. Should the company enter the loan agreement with the bank and begin taking the discount? Okay, so this is, you need to understand that, for instance, uh, the purchases are 100. Here the purchases are not mentioned, so you can just assume that the purchases are made 100, or even if you want to do 1000, so it's totally up to you, or any amount that you want to do, the answer will not change. Okay, so let's say the purchases are $100. Okay, so you made purchase of $100, and if you pay uh, the $100 in 10 days, you will get discount. But if you do not want discount and pay it on 25th day, you will pay $100 full. Okay, but if you pay it on a 10th day, so it means it is 1.7 by 10, mean on 10th day you will get discount of 1.7%. So 1.7% is actually 1.7. So 100 minus 1.7 is 98.3. So it means you will pay 98.3 on 10th day if you pay. Okay, so you will get a discount of 1.7. So if you see the difference here, so how many days earlier you are paying back? So you are paying back earlier by 15 days. Okay, so now you are thinking whether you should pay the discount. Sorry, you should pay 98.3 as a customer. You are thinking, should you pay 98.3 to take a discount of 1.73, or should you use 98.3 and for remaining 15 days and not take discount? So you need to actually compare. So it means this 1.7 is the benefit that you are getting for not using the 98.3 for how many more days? 15 days. Okay, so it means this is a return on 15 days. So this is not return on 25 days. This is return on 17 days, because you are estimating your evaluation on 10th day. Okay, So now you are thinking whether you should wait, you should use 98.3 for the remaining 15 days and do not take the benefit, or you pay 98.3 and not use the funds and take the benefits of discount. So you need to evaluate this benefit. To evaluate that, you need to calculate effective annual return. So they're calling it cost, but I'm doing that with respect to profit so that it's easy to understand. Okay. So if you see the benefit is how much? 1.7. If you do not use, you will get this one. Okay. Okay. So this is 1.7. So to pay 98.3, you are thinking to pay 98.3 so that you can get how much? 1.7. Okay. So so let's say, what is the return that you are going to get? So that is equal to 1.7 divided by 98.3. Okay, so the answer is 1.73%. So this 1.73% is, remember, for how many days? 15 days. 15 days. Okay, so now this is the return for 15 days. So since now you are evaluating your choice, you are thinking that whether should I pay 98.3 or use 98.3 for remaining 15 days. So let's say if you want to pay, okay, so you have thought to pay. So how would you pay? Because you don't have cash, or maybe uh, you want to take some loan from the bank. Okay, so you go to a bank, and ask for the loan. So the bank will give you a loan of 98.3. So you take this 98.3 and pay it to your supplier. But what will happen after some time? You have to pay back this loan to bank. Okay, so you will pay 98.3 plus bank will also charge you some loan. Okay, but remember, the banks, they are not going to give you loan for 15 days, right? So the loans are not available for 15 days. Loans will be available for 1 year. Okay, so it means you have to, if you are comparing this interest payment that is for 1 year with this interest payment, with this return that is just for 15 days, so that is not a good idea. So it means we have to convert this rate will be available, annual rate, bank rate will be available. We go to a bank, we tell them that we need 98.3 and they will tell us the interest rate. But this one we need to, this is for 15 days, so we need to convert it into yearly rate so that we can match. Okay, so to do that, what do we need to do? We calculate effective annual rate. So they have written cost, sometimes they write cost, but yeah, here they have written effective annual rate. Effective annual rate is equal to 1 plus EPR. EPR means the rates for 15 days power 365 divided by 15. 15 is the period minus 1. So this is exactly equal to M. Okay. So if we convert that, so our answer will be 51.179%. So it means if we take this discount, our annual benefit would be 51.79%. But the bank is offering us 10.8%. So it means that if we take a loan of 98.3 at the rate of 10.8%, so we are earning more than what we are going to pay to a bank. Okay, so in this situation, it's better that take a loan from a bank, pay them 10.8% and get an annual benefit of 51.79%. Okay, so let me explain this again. This point is uh, sometimes difficult. For instance, a purchase of 100 is made. Okay, and discount period is 15 days, 10 days, and total period is 25 days. Okay, so if you pay in 25th day, you will pay total 100, but if you pay on the 10th day, you are going to pay 98.3. Okay, so it means that now you need to decide whether you should pay 98.3 or not. You need to decide. Okay, so it means now understand this very carefully. If you pay 98.3 now, in other words, you are not using 1.7. You are not taking, you are not using 98.3. If you pay now, I mean, it's already paid. So it means that you have not used 98.3 funds. Okay. So and the benefit that you think will get is 1.7 if you pay 98.3 now. Okay, so the difference is for how many days? For 15 days, and the benefit if you pay now is 1.7. This is the difference. Okay, so you need, but this is for 15 days. We need to convert it online for 1 year. So what do we need to do? So we need to calculate the return of the discount. Return of discount. So that is 1.7 divided by for 15 days. So you will get your answer. So this is 1.73%. But this is for 15 days. Okay, we need to convert it for annual rate. So we need to calculate effective annual rate. Effective annual rate is equal to 1 plus 0.017, 1.017 divided power 365 divided by 5 minus 1. This is the answer. So this is how you match it. This is the return from the discount, and this is the rate that is bank is willing to pay you on 98.3. Okay, so it's a very simple case. So you just need to do two things. Whatever is the discount here, so you will subtract the discount, you will write 98.3, and you will again write the total payment. So simply, what is the difference? Take the difference, 1.7 divided by this answer, you will get the answer, and then you need to convert it into effective annual rate. Simple. Okay, so now let's take our question number 5. Your firm purchases goods from its supplier on terms of 1.5 net 35. Similar question, but this is slightly different. Okay, so 35 and 15 instead of 10, now it is 15, and the discount period, okay, and discount is 1.7%, but the purchases are not mentioned, so we will assume that the purchases are 100. Okay, so it means if we pay on 15th day, we are going to pay 98.3. If you pay on 35th day, we are going to pay 100. So again, the total difference is 1.7. But the time period is different here. It is 20. Previously, it was 15. Now it is 20. So we need to again convert effective annual rate for this period. So how do we need to do? First of all, we need to calculate the rate for 15 days. So the rate is 1.7 divided by 98.3. Same answer, 1.73%. So again, then we need to convert effective annual rate. Effective annual rate is equal to 1.0173 power 365 divided by 20, because this time it is 20 minus 1. The answer is 36.74%. Okay. Now, B part is very important. The question is asking us, what is the effective annual cost to your firm if it chooses not to take the discount and make its payment on day 45? So it means that the company is now extending the credit. Okay. Now there are 3 points. 15, the original payment period, but you are stretching it to another 15 days and another 10 days. Okay. So if you pay it on 15th day, so you will pay 98.3. But now instead of paying on 35th day, that was total a period of 20 days, you're stretching it for 10 extra days. So it means it is 30 now. So 10 more days. So you want to pay 100 on 45th day. Okay, so same thing. I mean, nothing will change. So just the time period will change. Okay, so this is 10. Okay, so the total period is 30 days. So simple, same thing. Again, you will do the same thing. So you will calculate the rate 1.7 divided by 98.3. The answer will be the same, 1.73%. But now the period previously was 20, it will be converted into 30. So this is 30. Same answer, same thing. Rest of the information will be the same. The answer is 23.2%. Okay. So here the bank rate is not given. So you cannot make the information whether you should pay or not. But for the comparison, in the previous question, the bank rate was given, but here the bank rate is not given. So you just need to calculate that this is the rate that you will get, and this is the rate that you will get if you pay it on 15th day. Okay. Now, last question is, sorry, I mean, the working capital chapter is more of an accounting kind of accounting chapter. Theory, I have explained that in lecture, but there is not many concepts that I can discuss here. So that's why it's just a simple, these are very simple questions, and we just need to calculate the periods and all that. Otherwise, if in terms of corporate finance, I mean, the concept wise, it is not that rich. So that's why it might look very accounting topic. Okay. The Manana Corporation had sales of 54.3 million this year. Sale. Its account receivable balanced average 56.9 million, 5.6 million. So this is account receivable and this is sale. So it means we are given receivable and sale. So the question is asking us, how long on average does it take the firm to collect on its sales? So we need to calculate our receivable days outstanding. So we need to calculate account receivable days is the account receivable divided by sale. Daily sale mean whatever the sale divided by 365. Okay, so account receivable divided by sale divided by 365. So our answer would be 37.64 days. So it takes from 37.64 days to collect receivable or convert receivable into cash. So these are some of the questions that we require to do in the working capital management.